How do ultra high net worth individuals manage a $100 million portfolio plus in the current market conditions? Let's take a deeper look and discuss a couple of those concepts. Hey and welcome to today's video. My name is Julian. On my channel, it's all about the various topics of investing, mostly cryptocurrencies and Bitcoin. It's all about explaining these ideas of decentralization, blockchain, and so on, which I call becoming cryptofit, fit for this world of decentralization. But we also discuss general market conditions, how to kind of approach those and how to kind of deal with them. So stocks and bonds, real estate, precious metals, and further going deeper into this rabbit hole. Now we have this series, and today I want to finish this entire series of how do you invest certain amounts. So how would you invest $1,000, $10,000, $100,000, $1 million, $10 million? Now I did all this based on my own experience. And now we do this final video of this series where I don't speak out of my own experience. I talk about friends and people that I know that, have $100 million plus, not as a fund. So I'm not talking about how you would invest other people's money. I'm really talking about your own money here. And so I will kind of share this and how I see people doing this. I'm not sure you might be watching this yourself with 100 million. Congratulations if you do, but it's not that likely because obviously there are not that many people in the world. So it might be probably more for your own interest rather than saying, okay, great, let me know how I'm gonna do it. So I just want to kind of say this at the beginning. And then, before we go in, this video is sponsored by Cake DeFi. If you haven't checked out Cake DeFi, go to pool.cakedefi.com. I'll post that link in the description as well. You can get 9% on Bitcoin there, completely transparent, so you know exactly how it works. It's all about trusting, but being able to verify. And you can get 8% on Ethereum. Then there's other coins that you can stake. For example, DFI, close to 30% per year. You can get Dash, PivX, C-Coin, so you definitely want to check it out. Lot of new features coming in. So yeah, check out Cake DeFi down in the link below and get some really nice cash flow on your crypto. With that, let's go into today's video and let's kind of do a bit of a brainstorm, maybe a bit of a repetition here. And that's also maybe a bit relevant if you kind of think about it. So we did a lot of kind of reflection here in the past. So you might want to go back to the other videos because some of the concepts here are very, very similar. But now here is the key thing. When I talk about $100 million, I'm not talking about paper net worth because there's a lot of people, especially in the startup world, right, who own $100 million based on paper, but it's not really liquid. So here I'm really talking about liquid 100 million, and liquid doesn't mean that you can move them in every day. So I'm not talking about fiat or crypto or something. It can also be real estate. Now I get that real estate is not always considered to be liquid. I get it. But really, like what I'm not talking about, let's exclude it here. What I'm not talking about is that you own 30% of a company, of a startup that's worth 500 million, and now you own 150 million, but it's completely liquid. Like you cannot really sell this part, right? So I'm really talking about 100 million liquid, and how do people kind of invest this stuff, or how do they manage it? Now, there's a couple of things that happen when you are at this level. And actually at the $10 million level, this already started. But here, this is getting extreme now. And this is returns on this portfolio, right, are 99% more often higher than any kind of income, right? So here, it really makes sense to think about each percentage point. And I mean, it's clear. I mean, 1% here is 1 million per year, right? So it really makes a difference here if you start focusing on each percentage point. And that's very different to the smaller amounts. And the interesting thing is this, right? So let me kind of talk about the interesting thing. The interesting thing is that generally speaking, people, when they invest $10,000, they care so much more about 1 percentage point or 2 percentage points, where it would make so much more sense when these people actually invest their time into actually gaining more income. And here, this is where people should really focus on this. And this is where it gets relevant, right? And this is where, in general, people really focus on how they kind of generate their returns. Now, here are a couple of general ideas that I think, right, that most people that I personally know, how they invest money here is quite interesting. So I know two types of people. And the first type is actually quite a more common type. And that is, they have a majority of their liquid funds, in their business. But it's liquid because it might be a publicly traded company, or it might be a company that they started and they kind of scaled it, or it might be a fund that they own, but they actually have their own funds in there, right? So they have a majority of their funds in business, and then now it gets very interesting, and the rest is in real estate. And that's the first type of people that I know, and the concepts here are quite interesting. What these people learn, right, is that it's very difficult to get strong returns unless you really kind of control business yourself. So there's a lot of people that kind of learn this way. And so they don't go for, I don't know, they don't go for all these things where people say, you know what, you should go into crypto because in crypto you can 100x your money. And they're like, oh great, I can 100x my money. Let me put whatever money in there because I can 100x my money. So they're not falling for this, right? So what they really understand is that the majority of their money, if they really want to take an average, well, the average would be, I don't know, 7 to 8%, and that's kind of the average out of everything. And they kind of understand this, and they want to know if I can outpace those 7, 8%, it really only works if I have an unfair advantage, right? And so they understand it. And many of those people, they actually don't trust many other people because they have learned that, well, they get hunted down so much that they've actually lost probably a lot of money by entrusting people to other money to other people. So this is the first type. And so the reason they do it their own business and real estate, because both basically allow you to have this unfair advantage, right? Here you have an unfair advantage because you know this business, and real estate, by definition, you should only buy real estate, in my opinion, if you actually really have an unfair advantage. Because most of the time, otherwise, it makes way more sense to buy an ETF or to buy a slice of the market, because generally, you normally don't underperform real estate, but you have way less risk if you just diversify here, right? So, and you have no work. So, but many times these people then go and say, you know what, let me buy an entire apartment complex. That thing is gonna cost me, I don't know, $50 million. Let me put half the money down, so that's 25 million. Let me put 50% down. And then, you know, I kind of have a management company, but I have all the insights, and I kind of, it's pretty much like an own business here, and I just let it run. But for me, this is purely an investment, right? So this is the first type of person I know here. Key, again, here, every percentage point counts, because here it's really about a lot of money. So that's the very first point that I want to make here. Now the second types, right? These are generally the types that don't have their own business anymore. So they don't have their own insight anymore. They really exited out of this. This can be either because they maybe they have inherited the wealth, or they are at the stage already where they are completely out of their business. And so they don't have this extra insight anymore. And so here, these types of people, they really kind of, and maybe they have a small amount here, right? A small outside amount. So actually the small outside amount basically would be beta, right? And this here is pure alpha, right? If you compare it to the rest. And so what they actually have is they have a very small beta only, but this small beta is still enough for them to retire, right? So this might be, I don't know, 10 to 15 million. It's for the average person, right? This is like insane amounts. But the majority of money is here simply because that's where they can really control their destiny, right? So I think I just want to kind of highlight that. And so this part here is still larger than in the other videos, what kind of money these people have. They just kept living the philosophy of, well, double down on how you got there. And how you got there is by generating income. And most of the time, you get there by generating income from whatever you make. So mostly a business, right? So that's how they got there. Now, the second type, generally speaking, is an evolution of the first type. And it is because maybe their business, they're exiting out of this completely and they don't have enough insight anymore. And maybe it's coming down to another generation, or it's just getting diluted, or it was sold to a PE, or it's completely public. And so now, obviously, it gets very interesting for these people to kind of understand, so where should I put this large chunk of money that I have from there, right? And many, many times, this is actually what's happening. So what is basically the principle then there is, it's really about diversification. And since it's, again, you have already this large chunk of, I don't know, 10 to $50 million that you're really sitting on, what these people then really try is obviously they diversify, I don't know, 10 million or 5 million chunks into all these different verticals, right? So this is where they go into private equity, this is where they go into venture equity, this is where they go into real estate. They might, interesting here is obviously they also go into marketable equity, right? So this is where they really go in. This is where they go into collectibles. And this is kind of the idea here, right? And so obviously and then they start, I don't know, maybe they have more of a PE fund here. They go into 3 different funds. So they might do, I don't know, 5 million here, 5 million here, 5 million here. They might have like 2, 3 venture equity funds where, I don't know, maybe they put 5 million, 5 million, 5 million. They have like entire real estate projects where they go in with 10 million, 10 million. Then when they go up, when they talk about, so and then they have the beta here. So that would be alpha, right? And then they do marketable equity here. And then they go here, they go into stocks normally, right? So I don't know, they would have like 10 to 12 different stocks, individual stocks here. And then they do entire collectibles, and many times these are hobbies, right? So this can be cars, and so on, right? And then they would have a beta portfolio, which is generally speaking the entire kind of like distributed, uncorrelated thing. And now, and one thing I tell you that all of these really high net worth individuals have is they all hedge. That doesn't mean they go with hedge funds. It just means that they go and they understand that there's massive, massive risks. So every year they take a certain percentage, maybe 1 or 2% of the entire thing, and they use it to hedge, right? Tail end positions. And they all do it. They might either do it through funds or they might do it themselves. And that's simply because they know how dangerous these things can be, right? So, and this is where we're way more in the second type. Obviously here it's really more about diversifying in a general large perspective, because at the end here, it's really about, it really comes down to every percentage point that makes a massive difference, right? So here, if you think about, okay, so you have someone working, well, it's easier here to tweak out another 2% per year in your portfolio, and that gives you $2 million per year, which at the end is something that's really hard to actually earn as a regular salary. As a regular salary, earning $2 million, you really have to be like a high executive in a large company that you can really kind of negotiate in this kind of level salary-wise. So I just want to highlight that. That's kind of how they manage. And the funny thing is, I mean, I know billionaires, and the interesting thing is it doesn't change much. From that level onwards, and I've regularly seen this, when you are in the triple-digit millionaires into the billionaires, it doesn't change much. It doesn't. It's just the deal sizes get larger. It just means that they might use their additional funds. It's impossible to manage all this yourself. So either they have family offices or they kind of entrust other people, but that's obviously always a bit tricky. So that's just an important concept in all of this if you understand this. And then obviously the question is, how does their life change when it goes higher? Now, you could always outspend, right? So that, let's kind of finish with this, right? What's the final outcome for them? I mean, you can always outspend, right? You could always go and say, I donate 100%. So you can always spend more than you make, right? So even if you're a billionaire, in theory, you can always outspend. So don't ever say you cannot outspend. You can always outspend. But so obviously at some point, it's very difficult to have expenses, regular expenses, that are rational, right? I'm not talking about just that you are on purpose outspending, but it's very, very difficult to have expenses that are higher than you're generating in returns from your entire assets. And normally speaking, right, if you think about really crazy high-end expenses, You're talking about several properties, you're talking about private jets, you're talking about any kind of transportation, any kind of security. Generally speaking, after around 300 million, that's normally what I see as kind of the limit. After 300 million, it's very difficult to start outspending if you're rational, right? Again, you can always be crazy, but then it starts getting difficult. And then what normally happens that people start accumulating, well, different kind of, I would call them liabilities, they call them assets, right? But that's when they start buying these crazy yachts. That's when they might start buying sports clubs. Now I understand that sports clubs can be a strong investment, but many times a lot of these owners actually don't make money. It's almost more like a hobby, and they're happy if they can kind of break even. Now it depends. Some clubs are actually returning some money, but that's normally after 300 million. So for most people that I know, they always tell me, look, once you hit 300, 400 million, afterwards, it's more of a number rather than that you could outspend. And then again, of course, $1 billion, you have more money to donate. Sure, you have more money to move the needle. And that's where I guess a lot of these super high net worth individuals kind of target or go at. Yeah, that's kind of the end of this entire series. I hope you get value out of this. If you did, then hey, click the like button, subscribe and follow. We talk about a lot of different investment things here. And I hope out of each and every step you got something out. One part might be more interesting just for curiosity, and the other one might be really actually relevant because that's the level you're at. And so yeah, with this, have a really good time. Subscribe, don't miss any of the videos on LinkedIn, follow the page, on VK, on Twitter, click the like button, on YouTube obviously, subscribe, and on the podcast as well. And yeah, leave me a positive review, I would appreciate that. At the end, don't forget to check out today's sponsor, Cake. And with this, I'll see you at the next video. I appreciate it. Thanks so much. Yours truly, Julian. Bye-bye.